Over the past few months, I've been noticing a trend among some dividend investors, which is that some people have been selling their shares of SCHD for a different Schwab ETF, which is SCHG. The reason for this is because SCHG has been killing SCHD this year and even beyond that from a total return perspective. If we look at a chart of these two ETFs, you'll see from a share price perspective that SCHG is up 41.59% and SCHD is up only 21.76%. Both returns are great, but there's no denying that SCHG has been the better performer. So in this video, we'll take a look at SCHG and see how it functions differently from SCHD and determine if it's worth holding instead of SCHD for dividend investors. Let's start by taking a look at what this ETF actually is. According to Schwab's website, SCHG is a large cap growth ETF. It says, the fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. It has a very low expense ratio, just like SCHD, and it also went through a stock split last week. It currently holds 231 positions, which include all the big-name companies in the market, including Apple, Nvidia, and Microsoft. This fund doesn't use any kind of process or stock-picking strategy to hand-select dividend-paying investments specifically. It only holds the investments in the Dow Jones U.S. Large Cap Growth Total Stock Market Index. I think the biggest reason why SCHG has become so popular recently and some people are swapping SCHD for it is because it's been the best performing Schwab ETF this year. According to Morningstar's website, this ETF has delivered the best returns in 2024, beating out their large cap ETF, their Schwab 1000 ETF, and their broad market fund. It's unfortunately kind of a common practice for investors to swap out of one investment that's performed decently one year for another fund that's been doing much better over the past few months. This ultimately isn't a good investing strategy for a couple of reasons. If you're constantly replacing the holdings in your portfolio every few months for holdings that have grown more recently, you're going to incur a significant tax bill at the end of the year. All of this selling out of holdings is going to result in a large number of short-term capital gains. This is when you buy a stock or a fund and sell out of it in less than 1 year after buying it and you earned a profit. Short-term capital gains are taxed according to your ordinary income tax bracket, which can be as high as 37% depending on your yearly income. Long-term capital gains, on the other hand, are only taxed as high as 20% if you make roughly $500,000 a year. It is true that this only applies if you're investing in a taxable account, not a TRAD or a Roth IRA. But if you're the kind of investor who wants to live off dividends before 59.5, then constantly buying and selling positions is going to be expensive from a tax perspective. It's best to find an investment that you're confident in that you intend to hold for a longer period of time, ideally much longer than just 1 year. But the second issue of replacing your holdings with ones that have done better in the short term is that there's no guarantee they'll continue to see a run-up in share price. Just because SCHD has seen a really good run-up in share price recently doesn't mean it'll do that every year forever. Some years SCHD will beat SCHG, and other years SCHG will beat SCHD. There are going to be periods, whether they're a few weeks or a few months, where one investment will do better than the other. Therefore, it's best to go with the holding that best aligns with your investing strategy. And there's one major difference between SCHG and SCHD, which is that SCHD is much better suited for dividend growth. SCHD mirrors the Dow Jones U.S. Dividend 100 Index. This index has a dividend-focused methodology when picking what goes inside of it, and it reconstitutes on a regular basis. It targets higher-yielding dividend stocks that have had many years of consistently paying out distributions, so you'll find a lot of dividend aristocrats like AbbVie and Chevron, as well as the Home Depot and Verizon, which are all offering higher-than-average yields in the market. These kinds of stocks make up a huge portion of this ETF, and these holdings are what contribute to SCHD's current yield of around 3.5%. SCHG, on the other hand, only targets large-cap stocks that they consider to be growth stocks based on several different factors. There's no consideration of current dividend yield or dividend growth when picking what securities go inside of it. With that being said, it's largely made up of tech stocks, which are investments that are well known for almost never paying dividends. These growth stocks don't generally pay a lot in dividends because these companies would prefer to reinvest all of their spare cash back into growing and expanding their businesses, so they don't really have a lot of motivation to pay shareholders a dividend or grow it for that matter if there is a dividend. If we look at the dividend growth these funds have provided, there's basically no competition as to which ETF is better. According to Seeking Alpha, SCHD has a 5-year dividend growth rate of exactly 12% as of the making of this video. Out of all the dividend growth ETFs out there, including VIG, DGRW, and NBOL, SCHD continues to not only offer the best current yield, but also offer the best long-term dividend growth. Looking at a chart of its dividend history, we can see it's continued to grow very consistently over time. Its dividends have nearly tripled over the last decade, which again is the best out of any dividend growth ETF that I've come across. With SCHG, on the other hand, it's a totally different story in terms of how much growth this ETF has provided. Despite its incredible share price growth, its dividend growth has been poor. Again, this shouldn't be too much of a surprise considering this ETF holds growth stocks, with the majority of what's inside of it being tech companies. In the last 5 years, there's been no growth in their distributions, and actually a little less than 5 years ago, according to Seeking Alpha. They're currently giving this fund a 5-year dividend growth rate of minus 1.76%. Looking at a graph, you can see there's been almost no growth since 2018. It has increased since 2010, which is right around when this fund launched, but looking at the amounts on the right, it's gone from paying 1 cent to 3 cents per share in 14 years. If it's your goal to live off dividends someday, this isn't going to be an ideal investment for you. Every dividend investor, I believe, should have the goal of being able to live off dividends without having to sell any of your capital. A life of being able to live off the distributions alone without ever having to sell shares of your stocks or ETFs is the most ideal living situation in my opinion. That's why I personally like holding higher yielding stocks, ETFs, closed-end funds, and so on. Given how low SCHG's dividend yield is and how slow the dividend growth is, you'll need to invest a significantly higher amount in this ETF to be able to live off its dividends today, roughly 7 times as much compared to SCHD. So in the end, SCHG isn't a bad investment. Its growth-focused strategy will likely result in really good gains during bull markets and tech booms in general. It's a solid ETF that's ideal for people who want share price growth. But specifically as a dividend investment, holding SCHG isn't ideal for those seeking to live off dividends. It's unfortunate that while its share price has been exploding, the dividends simply haven't. They haven't come close to keeping up with the rapid share price gains that it's seen. SCHG would be a good consideration for people who maybe want to pursue more than one investing strategy. If you like dividends but you also want to pursue a growth strategy in addition to that, then SCHG is a good investment and a good consideration. If it's your plan to hold SCHG and eventually sell it at some point in the future for dividend holdings instead, then that's another good reason to hold it. But don't replace SCHD with this if you're solely a dividend investor. The rate at which it grows its dividends is so slow that it'll take forever for them to snowball into an amount that's meaningful. If you have millions of dollars to invest, then you could earn a good amount in dividends today if you happen to have, say, $5 million. But I'm assuming most people watching this don't have that kind of money. So ultimately, it is a really good ETF, but it's not a good dividend ETF. And with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.